All right, so we'll go ahead and get started. We'll do a couple administrative things. I sent out a couple emails about the remainder of class. One was the form that has the information if you would like to work in the available offices. So make sure you get that into me. You can write on it, fax it, scan it, email it, or I put an address on there to mail it back in, but as soon as you can get those in, that would be great. Final exam, we will probably do, as I said, we're going to try to do it on December 16th and 17th. It will be just a computer one. The way we do the final exam, it has to be in person. I'm going to have hours here at Amherst where I will be doing it between 9 and 5 on Friday, and then during our normal class time on Saturday. So those will be the two options there. I'm trying to make arrangements. I do have to go down to Jamestown to do some stuff at Schultz Auto, where we're having an office. So I may set up a time down there, but I'll let everybody know when that might be so that we can try to do something. It's just a matter of having a computer there with the TaxWise on it so that we can try to do the exam and down there in the southern tier. So obviously depends on weather. So right now we've remained lucky, but sounds like by the end of the coming week we're going to get into our Buffalo winter, which will be so much fun, but at least we'll have a white Christmas hopefully. So all right, so we have that. What we're going to start out with today, some people had some interest in seeing the final exam and how the problem worked. So we're going to go, or excuse me, the midterm exam. So we're going to go through that. We'll talk a little bit about rental properties and Schedule Cs, okay? So okay, yeah, Cheryl, I definitely will try to find something down there. Like I said, it's corresponding with 2 or 3 different people as to what we need to get done down there. So I'm just trying to find out exactly when I might be available to do that, because I have to make sure our IT guy can be down there with me to get things set up right for the TaxWise. So I will let everybody know on that, okay? All right, so as I said here, we're going to start out just going through the problem, the midterm computer problem. Everybody did a great job on it. A few people missed a few things, but otherwise everybody was very, very good at getting the information in. So we'll go through it. As you remember, it was the Jensens. Let me just find my problem here. Okay, it was James and Wanda Jensen. Okay, so let me get the problem up on the screen here. Give me 1 second. Okay, so as you can see here, we have the Jensen problem up. We have their address in there. Everybody did a great job on the main page. They were married filing joint. We had Sammy, Sally, and Sarah. As you can see, they were all their children. I know we had on this one, we had an adoption. So we'll talk about that, okay? But everybody was in there. There was some dependent care, some earned income credit. Like I said, even though they did not qualify, I always want to make sure that you check that box, because that's a credit we don't want to miss out. So despite the fact that they didn't qualify, this would not hurt the return at all as far as being e-filed. They were New York residents all year long. We had their bank information. We put in a PIN number for them and everything on that, okay? So we'll just kind of go through line by line on the 1040 and talk about where all the information came from, okay? All right, so there's the 1040. The header was what we did from the main sheet, okay? Income. We had a couple W-2s. We had one, if you look on the left, you can see them in your tree. One from Candles and More. Okay. So the Candles and More one. You have to open up. There we go. Okay. So this one was for James. Okay. The one thing you had to make sure on this one that, most everybody caught this, is in box 10, you had to make sure that your dependent care was in there. Okay. When we look at the dependent care form, we'll take a look at that and see where that comes over to it. And always make sure down at the bottom that you don't forget, because sometimes out of sight, out of mind when you're doing the W-2, make sure that the state tax is entered there. Okay. We had a W-2 for, okay, Wanda, and had her W-2 here with her withholding. Okay. So everything was on there, nothing really out of the ordinary on hers, no dependent care benefits. So we just had to make sure everything was in there accurately, okay? Back on the 1040, okay, it shows up that we had some interest and dividends. Everybody handled these very, very well. Things go on a Schedule B. So we're gonna go to our tree on the left and open our Schedule B. We see the things reported there, but we always have to remember that things do not go directly on the B. We have to go inside there, okay? And when you're in that square there where it does say First National Bank, that's where you would open up your little screen and hit your interest statement so that you have the little worksheet that allows you to enter in all the information. Computer's a little slow this morning. That allows you to enter all the information off the interest statements that were provided, okay? So we had one from First National Bank, and then we also had give me 1 second here. Okay. So we had those on there. We had the ordinary dividends and the qualified dividends. A couple people just make sure that if you do have federal tax withheld, that's why it's so important to use this worksheet. So you can see over here to the right that where it says FED with, that was federal tax withheld. Make sure that you got that on there. Okay. Moving down, we had some unemployment, okay? The unemployment, the way we handled that is if you go into either one of the boxes and you use the little gray link box or you hit F9, it'll allow you to open the 1099-G, okay? As I've noted, when you're doing tax returns in New York State, New York doesn't mail out 1099-Gs anymore. So, you know, it is something that when you do the return, you will have to make sure that you ask if they had any unemployment because they might have forgot from the beginning of the year. And, you know, without that form being mailed to them, they would have had to gone online to print it, okay? So we have our little worksheet. We put in there who it was for. Make sure that you put in the amount, federal tax, and then also make sure that you put the New York tax withheld there, okay? Sometimes one of my classes, nobody online, but they put the amount in here, but they forgot to designate the state, so that it did not flow over to the state as it needed to, okay? All right, so that pretty much gets all of our income to the point of our gambling winnings, okay? We had a W-2G that was for Wanda, okay? So we needed to make sure on that we put that in. In the bullet points that came with the problem, there was a reference to it. It talked about the fact that she had gambling losses of 1,000, okay? So, gambling winnings, we go in there, again, the gray link box, or we can hit F9. We get our little worksheet for other income. Okay. All right. Once we get in there on line 1, we can see the gambling winnings are there, but the way we'd like to put it in is we're going to use our gray box or F9 key, and we'll go in there and we'll have gambling winnings here. Okay. So that's going to open up, as it says on line 1, a form W2G for gambling winnings. Okay, so looks very similar to any other W2 that we do, but the boxes are a little bit different. We have our winnings. We put all of our information in. There was some tax withheld. We need to make sure we have it there. I know a couple people just put the winnings straight on, and they forgot to get the withholding in there. The other thing is, it allows us down at the bottom where it says gambling losses to be transferred to Schedule A. So we have our $1,000. We put that in there. When we look at what we did on our Schedule A for itemized deductions, we'll see that that carried over for us. Okay. Back to the 1040. The one thing we will talk about is that on the bullet points, they did itemize last year. Okay. Over here on line 10, they had a refund. As it says, they received $540 as a state refund. They received the New York Empire Child Credit in the amount of $660 for the previous year. Okay. The way New York handles that is that if that credit or those refundable credits in New York exceed what your refund was, okay, so if it's, you know, the 660 was greater than the 540, that means we have no refund to claim. Okay. If it were the case that they only had one child that qualified, so they only got $330, we would have had $210 to report on line 10. Okay. For the problems that we do in class, as I've stressed, it's important that you understand that we just need to put that information as we know it on 10. There is a worksheet that is in box 10. Some people get into that worksheet. The thing about the worksheet is you need to have two things. Either a return from the previous year so you can fill out all the lines that need to be on the information on the worksheet, or you have a client that is in the system that is a previous year's client and their information carries forward. Okay, so make sure on that we have that in there. All right. Okay. All right. Now down below, we didn't have anything in the adjustments to income, so we had our gross income, $99,913. Again, everybody was very good there. Okay. Page 2 of the 1040. Okay. Our income carries over. Itemized deductions. Okay. We had several things in the itemized deductions. Okay. So we want to make sure that we got all those in there. There were things for different things that they had as far as their itemized, different things that they may have qualified for. Okay. Medical, they did not have enough medical to go over the 10%. We did have the taxes withheld from their paychecks, so that carries over to line 5A. We had real estate taxes. If you remember, there was a 1098 that they received from their mortgage company that had items on it, and that 1098, okay, had mortgage interest, mortgage insurance premiums, and taxes paid. Okay, so you can see in our taxes paid, we have our real estate taxes for our principal residence, we have our mortgage interest, and we have our mortgage insurance premiums. Okay, those do. So mortgage insurance does qualify for itemized. Home insurance does not. Okay, so personal home insurance does not go on the itemized, but mortgage insurance does. Okay. Then we had some things for our gifts to charity. Okay. So if we remember, when we go in there, those boxes are typically green. We go in one of the boxes in the Gifts to Charity section. We can hit F9 or use our little gray link box. We open up our little detail sheet. Okay. On our detail sheet, we didn't have any medical. The First Baptist Church, we gave some money to. That was a cash contribution. And then we also had some other than cash to the Goodwill. Did not need to do the 8283 because it did not exceed $500. You can see right here where it says other than cash contributions, use form 8283 if this total is more than 500. We did not have to use that. Okay, so we had that. As we move down, we did have some things in the section that talked about job expenses and miscellaneous others. Okay. Quickly, you can see down at the bottom where it says other miscellaneous deductions. There's our $1,000 that carried over from our W2G that we did on line 21 of the 1040. Okay. In this, we had some different expenses. Okay. The one thing we have to remember about this section that it has to exceed 2%. So we did have items within this, but it did not exceed 2% of our adjusted gross income. So we were not able to use any of it, but we still entered it. Okay. Unreimbursed employee expenses. Okay. They had some things that talked about union dues. All right. Typically, as I've said, the 2106 and 2106EZ are something for you to use as a W-2 employee to report unreimbursed business expenses, but it's best to use those only if there is travel expenses or mileage, okay? Otherwise, it's best to use the little line where it says type. We can go into the box there, hit F9, or hit the little gray box. We have the thing come up, and it is a Schedule A, line 21 business expense, okay? Once we hit that, it'll take us to a little worksheet, kind of looks like some of our scratch pads, if any of you have discovered that. Come on, computer. There we go. So you kind of have a little pad that you can put everything. The one thing I will tell you about the software is that things like this, where you use these little worksheets or little expense lists or whatever you want to call them, that are specialized for a line, they do carry forward. So these are nice when you put those on. Scratch pads tend not to carry forward. So if you want to list some things for a client in a category because it just has a total amount, but there might be several things, just remember that does not carry forward. You can always go back and look at the previous years if it's in our system and look at that scratch pad, but all those categories that you put on a scratch pad may not carry forward. So it's always best to use these ones that are pre-designed for a certain line, okay? So we have that. That's where our union dues are, okay? All right. We had some things for other expenses there. And we also had our tax prep fees, okay? So that's where we got to the total there. Again, right here, same as we saw in line 21 for line 23. If you go in there, F9 or the little gray box, you get a little worksheet. Those things would carry forward, so they'll be there as reminders for you, okay? So that's what got us to our itemized deductions, okay? A couple folks missed out on the itemized. They allowed them to take a standard, did affect your answer, but always make sure that you understand what goes on the itemized deductions. Always visit that no matter what. Sometimes there's years where they do have things that cause them to go over. Previous years, they might have been a standard deduction, but make sure that you always visit the itemized. The way our software and the way our billing works that Esther's set up is if you open a Schedule A, put information on it, and it does not help them on their return, we don't charge them for it. There are a lot of tax companies that charge you every time they open up a form. That's one way we keep our cost to the client down, is that we may use the form, but if it's not used to finish their return, then there's nothing that we charge them for, okay, if it's not going to affect their return. All right. All right. As we continue down here, we can see the exemptions for everybody in the household, 5 in the family, $4,000 per person. Okay. It used, because we had some ordinary dividends, the software will do this for you, but that is why the Schedule D tax sheet was used. Okay. Dependent care was the first one that we had. Okay. So on our dependent care, we had a little form that was in the packet for the return that was from Mother's Helper. Okay. Mother's Helper, up at the top, we put that amount paid in there. But as you can see, this actually adjusted from a calculation on page 2 of the 2441 because of the $1,000 benefit that Mr. Jensen received on his W-2. Okay, we have Sammy and Sally. Part 2, there is only 2 spots for names. So on your tree on your left, you would have noticed that a 2441 worksheet would have popped up. All right. On that worksheet, there is a header, but as you notice, this is just an extension of what we put on page 1. It doesn't need to be put on there again. All right. And down at the bottom, it has a spot for Sarah. Okay, that is put on there. All right. So that's the way the credit was for that. And that's how we got the credit calculated on the 2441 for our dependent care based on the 3,082. The form calculated that for the credit there. Okay. You can see each one of the children, they got a full credit, no phase out for their income. All right. 8839, we had an adoption credit. Okay. A couple people had a little trouble with this, but this was for their daughter Sarah. This was one of the things that was in the bullet point that said the adoption of daughter Sarah just became final on October 2nd. Their qualifying expenses amounted to $3,125. Sarah was not considered special needs child. Okay, and remember that's important because if she was considered special needs, that would change the amount of credit that they would be eligible for. Okay, now we have Sarah, all of her information there. Okay. We have our qualified expenses. So that's what generates our credits, okay, on the tax return, the adoption credit, which obviously in this situation is a very lucrative credit for them. Okay. It was a pretty cut and tried one. Sometimes with adoptions that have been dragging on for a year or two, you can see down at the bottom, as we've talked about, there's some things that happen that they may have taken a portion of the credit and it keeps carrying forward for them. So as they're trying to get the adoption done. Okay. All right. So we had the adoption credit. So those are 3 of the credits that were in our non-refundable section of our 1040 on page 2. Okay. So as we have that in there, that ate up most of our tax bill. We had $673 remaining. Here is our tax withheld, the $37.64. And when we took that, and with our total tax is where we generated the refund of $3,091. Okay. On the New York side, there's just a few things you had to clean up. One was a little box that you have to check on the 1099-G. But as we can see, if we go to page 4 of our IT 201, Okay, we were able to have our tax that was calculated. We have the Empire credit. We have the family wreath credit. We have the dependent care, so they got not only a federal but also one. This $350, that family tax relief credit, that's the credit that started a year or so back. It used to be that families got it as a check in the mail, but now it's part of the tax return. We had our tax withheld, so we put that against our tax bill, and that's where we had the refund of $387. Okay, they were able to itemize. Whoops, excuse me. Okay, so everything carried over from the federal. There we see that $99,913. Down below here, we did get to itemize. As you can see, the amount is different, okay? The itemized and the way they handle the deductions and the exemptions is different. Here is the exemptions for the 3 kids, but are itemized, okay? On your tree on your left or within the square there, you can go look at those. We don't have to complete an itemize like the Schedule A. It automatically does that for us. But I'm going to go take a look at it, and I just want to show you what happens on the state side when somebody itemizes that may make the amount different than it is on the federal return. Okay? All right, so here is our itemized deductions, okay, for the state. You can see here's that amount that we saw on the state. However, remember that state, local, and income tax that we paid, the stuff that was taken out of our paycheck? We do not get to claim that on the state side. So that is subtracted out, and that's where we get to the different amount. Okay? All right. So that's where we got to our total for the federal and the state on the midterm exam. Okay? All right. Anybody have any questions on that? I'm going to turn on, I'm going to unmute everybody, but if you want to mute, go ahead and go back on as a mute. Any questions on the midterm? Like I said, everybody did great. The one thing that I did see with the errors was a little bit handling of the Schedule A and the itemized deductions. So we just need to make sure that you take time on that. Make sure you get all the documents and always double check. What I do when I do a return, as I have a yellow highlighter, I choose a color each year. I try to vary it because I just don't want to have to stare at the same color every year. But I will make a mark on each of the documents that I put in there, a check mark or a little X or whatever it may be on that person's tax document so that I know I have entered it. Okay? All right. Any questions? Okay. All right. So I'm going to put everybody back on mute here. And what we're going to do is I'm going to cover, oops. Okay. All right. And what I'm going to do is just cover some things out of chapters for the rental income and business income, okay? The way I'm going to do this is I'm just going to do, I'm going to kind of show you some of the problems, talk about each of the items. The one thing that is in there that we won't spend a lot of time on, I'll give a brief description of, is depreciation. The thing that I want you to remember with depreciation, depreciation is kind of unique between rentals and business income. It allows us to basically expense something that is a capitalized item over several years, okay? On rental side, obviously we want to take that rental and we don't want to take all the expenses in one year. We want to spread the expenses of owning that rental property besides what we do on an annually or yearly basis. We want to try to spread that out, okay? So That being said, that's what depreciation will do on there, okay? So what I'm going to do, give me just 1 second here. If you want to grab your workbook, we're going to talk about basically with the items that we do, that we see in a Schedule E for rental. We're going to use problem 9.1 for Nancy Jones. It's problem, or page 95 on there, okay? So page 95 in your workbook, we'll talk about all the different items that go in there, okay? Nancy will come up here. I apologize if my voice is a little scratchy, but trying to get through the last of what I hope is my cold so I don't have to worry about it the rest of the season. As I'm getting open, if you want to, more detail about all the different items and things like that, just because we kind of have a limited time each Saturday, those on the YouTube channel. There are recorded lectures. The chapter 9.1 is up. Right now, the chapter 5 and 6, I did that yesterday with my classes. That one is just being compiled and edited. I'm hoping to have it up even right after class is done today. It's compiling itself to get ready for the format for that, okay? All right, so we're going to take a look at Nancy Jones so that we can talk about her, whoops, that's the wrong one. Sorry, hold on 1 second. That's not Nancy. Where did Nancy go? Well, that's not what I wanted. There she is. Okay. All right, so we have Nancy here, okay? So, as we see on the bullet points, if we go to page 1 of the 1040, okay, whoops, come on. All right, so on page 1 of the 1040 here, she does have some W-2 income. She works as a hairdresser, I believe. Yes, okay. So she does have W-2. She had some interest income that we put on there. You can see on this one, she itemized last year. However, she ended up here with a refund, as it says, of $342. So we had to put that on there because she did not have anything to offset it. Okay. Now, here on line 17, we have a rental real estate, royalties, partnership, escorts. These are all items that show up on our Schedule E. You'll see a discussion about them in the Chapter 9. We're really only going to talk about the real estate. We'll touch on royalties a little bit. Partnerships, S-Corps, trust, that's page 2 of the Schedule E. Those are things that would be on a Schedule E. Really all you have to do is, if somebody has one of those, they would bring to you what's called a K1. K1 is nothing more than a W-2 for somebody that has income from a partnership, S-corp, trust, estate, whatever that may be, okay? So we're going to use this line. When we're here, we go right into our sheet. We can see here that we have a Schedule E, page 1, page 2. As I said right here, page 2, you can see it says K1 information. So we know that that's where our K1 is going to go. We're going to be on page 1 for this, okay? All right. So our Schedule E, and this is again where our rental property income will come into. As we can see on here, it talks about some different things up at the top. One thing that it talks about is 1099s. Remember, that's miscellaneous income. We will talk about that in chapter 5 and 6. For our cases here, if I have somebody that I pay to plow the snow, or I have somebody that's living in the property that I have them take care of the property and I pay them, I may issue them a 1099 if it's over $600, just because I need to have record that I paid somebody some money for that, okay? As we come down here, we see that we have a little table for information. Talks about our different codes for our property, okay? If somebody's renting a home, it's a single family. If you own a duplex, and even though you may live in half of it, which is similar to what we're going to talk about here, that would be a multifamily, vacation or short-term rental. One thing I will say about those, as you saw in there, if you have a short-term rental that is less than 15 days. Best example of this, if any of you are familiar with Rochester, New York, and Oak Hill Country Club, they have a golf tournament there every once in a while. And it's always a very big golf tournament, a national event. So they have a lot of the professionals, their families, the media come in. Several folks around Oak Hill will rent their homes to the players and the media and the dignitaries for a couple weeks leading up to the tournament. Basically, they vacate their home. Some of them get $10,000, $20,000, $30,000 renting their home. So let me know if anybody wants to rent their home next time, and I'll see what I can do for that, okay? That being said, because that is less than 15 days, that's basically, as the book says, tax-free income, all right? Yes, you do have to be out of your home and have somewhere to go for 2 weeks, but that might make a couple good mortgage payments or, you know what, some great renovations. But that the income is tax-free for everybody, okay? All right, so we have all of our information up here, even land. Royalties, number 6, okay? If we receive something that's royalties, that would show up on a 1099 miscellaneous when we see the 1099 miscellaneous here, okay? So we will make sure that we talk about the fact that that just goes there and that would carry over for royalties, okay? Now, in this problem, Nancy has a rental, okay? And it is actually at 65 Pinewood, okay? So she has basically a house, kind of a duplex that she rents, okay? So we have a multifamily because there's more than one spot in there. Even though she's one of the families, it still is a multifamily, okay? Here on rents received, we have 2 choices, okay? If you notice from the problem on page 99, she has, and you'll see the 1099s like this if you have rent subsidized or, you know, in case of the rental or housing authority. So you can see on 99, she has a 1099 miscellaneous because this individual's rent is paid to her by the city rental authority. If I have somebody that's renting that I just know is a tenant, I may not get a 1099, okay? I would just put the rent in there. Or you can enter the 1099 miscellaneous in there, okay? If we go here and we take a look, you can see that we have a 1099 miscellaneous. We can put it in there, or we can just put the amount directly, okay? Now, owning the rental property, I get to put expenses against my rental income. Advertising. if I put an ad in the paper to try to rent it. Line 6 is auto and travel, okay? If I have a rental property that I have to drive back and forth to either collect the rent, or I'm responsible for mowing and shoveling the snow, or, you know, I go to Home Depot to pick up some supplies or some things to do to the repairs and things like that on the property. Those are all mileage I can keep track of, okay? Cleaning and maintenance. Some of that can be listed here, you know, if it's between tenants and you got to clean it, or maintenance, you might put on there that they had exterminator, but I'll kind of show you something else that we do on that, okay? All right, so we have that. Commissions, that would be if I paid somebody a commission to get my property rented. Say it's on one of the websites and you try to get it rented, and there's a commission to have that rented, you could write that off as an expense. Insurance, okay? In this case, it talks about on the bio sheet there, all right? I'm sorry, not on the bio sheet, but on the page 98, the 1098, it talks about her mortgage interest, taxes, and then it has her home insurance. In the case of a rental, for half the house, okay, so you can take half of it because she lives in the other half, but the half that is rented, she can declare the homeowner's insurance. So this is one of the times you do get to deduct your home insurance, okay? We have legal and other professional fees, okay? Legal fees might be a lawyer drawing up the rental agreement or trying to get somebody evicted or whatever it may be. Management fees, again, if you own something that is in a community and maybe there's a management group that oversees it for you, you may have management fees that you pay to them, okay? Line 12, this is where on this problem we have to make sure we understand mortgage interest. On her 1098 there on page 98, it talks about mortgage interest of $11,500. Mortgage interest in a rental property, you can only deduct towards the rent any mortgage that goes to the rental. In this case, half of it. The other half goes over to her Schedule A for herself on her itemized, okay? So we do know that she itemizes on this. Our Schedule A, if you look on the tree on the left here, you can see the little blue check mark shows that she was able to itemize also, okay? Repairs. Repairs that are simple repairs that aren't really capital improvements can be put on there. In the case on page 95 in the little expenses, it talks about repairs to the roof. Well, the roof is over both of them. So she cannot write off the total amount because she lives in half the property. Now, I have had clients argue that if it's an upper and a lower, and they live in the lower, that the roof is over the upper. That's not the case, okay? If it is you as the owner and a rental, I don't care if it's side by side or upper lower, you still have to share the roof, okay? So don't allow anybody to tell you, well, the roof's not over my head, it's only over the second floor. That's not the case, okay? Obviously, they didn't have much leg to stand on that one, all right? So we can see we had the $89, it rounded to 45. Again, property taxes from our 1098, we took half of that. Utilities, okay? We can see there that we had water. It was $750 per year for the entire property. Again, I own half, or excuse me, not me, but Nancy owns half. We can only take half of the utilities, all right? Depreciation expense. Here's where we're going to talk about that. If you take a look on your left, you will see this little 4562 on the tree with all of our little assets, okay? If you notice on the things, we have the house, it talks about that. It talks about the stove and talks about a bathroom remodel. Those are all capitalized items that are part of the rental property, okay? So on this with depreciation, on line 18 of the Schedule E, we're gonna go in there and we're gonna talk a little bit about depreciation, okay? So F9 in there, we get a 4562, which is our depreciation. And we can see we call it depreciation of the rental, okay? Once we're inside there, we can see that we have our depreciation sheet, okay? This is kind of like I talk about the Schedule B. Everything goes on the 4562, but nothing is put on the 4562, okay? If you take a look at 6A, it says description of property, okay? We want to describe each of the properties here. I think this is a great place to go. If it says for accurate computation, that sounds like a good idea to me. We're going to F9 in that field for a worksheet, okay? You can see here, I have my worksheets. I have rental clients. I have 2 or 3 clients that have 10, 12, 15 properties. Each one of these has a little sheet, and when I open up a window like this, I can see a list, and I may have to scroll down because they've owned them for several years, possibly decades, okay? So all of them are listed. In this case, we're going to go in, and we're going to open up the one that talks about Pinewood, the actual home, okay? So we're going to create a little asset worksheet. Okay, so here's our asset worksheet, and this is where we're going to enter all the information, okay? Typically what I'll do, just as I've done here, is I'll put the address for the main building. Asset type, okay? This one's very important because when we get down here below, when we see where it says on 4, recovery period, this is what's going to determine how long we get to depreciate the property, okay? For how many years do we get to use this portion of our rentals as against our income, all right? When I have this, we pull it down, okay? And it has a list, and you can see, you can scroll through, there's a whole bunch of different ones, okay? Ones that appear for our rental, obviously appliances for rental, carpeting for rental property, okay? We have furniture and fixtures for rental, okay? We have improvements to residential for anything that is leased. Okay, so we have that, and then we have property, residential rental. That's what we've put this one under, okay? Because this is the actual residence that we're renting. In the bullet points, it talks about when she purchased it, so that's when we have to say that we put it into service as a rental. The little thing that talks about rental assets, okay? This one has a little thing that pulls down, and you can see A, B, and C. That A, B, and C correlates to those columns from your Schedule E, okay? Now, the address is 65 Pinewood. The little number 2 that is ahead of it, that's the code that we selected on the Schedule E to say that this is a multifamily, all right? So we have that, okay? So we're going to make sure we're on 65 Pinewood. Answer the questions as they appear. All right, and it is a residential rental. Now, on the sheet, it talks about the fact that she paid $135,000 for it, and it had land value of $13,500. We can see that with our cost basis, what we paid for it. We can see that we subtract the land. Land is not depreciable, okay? So that would get us a number. However, half of this, we put 50% in there on C, only half of what we get as our basis is depreciated, okay? So we can see, we use this method, will automatically come up. Rental properties are always done as mid-month. That's what the convention is. We'll talk about that at another time, okay? I just want you to understand how the form's completed. This was completed, the 27.5 was based on our asset type that we selected, and it gives us our current depreciation. We'll talk at another time about how to calculate the prior depreciation. It'll be red in a lot of the homework that you'll do. Just leave it as a red box for now. Don't worry about it, okay? So that's how we determine the expense of owning that rental, that half of the rental that we can put against our rental income, okay? As you can see here, there's a worksheet that we did. It talks about the fact that she bought a stove. We put it in as appliance. when we bought it, what property. It is not real estate, so we're not checking the box, but you can see here, we took the cost. It was 100% because it was for the rental side. It wasn't a stove that they were sharing. This was just for the tenants. So we have that, and it gives us the determination of our depreciation. Again, little bites that we can put against the rental income over the 5 years that that stove may be in there. That recovery period is basically what they determine as a useful life, okay? The other thing that we did was a remodel. They remodeled the bathroom, okay? Obviously, must be a very nice bathroom, okay? Because it was for the tenants, all right? She must love her tenants because she did an $8,678 bathtub. I would assume that it's all marble, gold-plated fixtures, probably has a hot tub, okay? But you can see leasehold improvements, when it was done or completed, the property. Yes, this is part of the real estate, okay? Because it's part of the structure. We have what it cost, 100% again, because it was all for the tenants. Shows that we're going to depreciate this because it's part of the structure over the life, okay? Now, this is where tenants will, if they own a property for 30, 40 years, they fully depreciated the building. This is where they'll choose to do some remodeling, a new roof, new siding, so that they can then start over the clock for 27 years of things to put against their rental income, all right? So we have that. You can see again, mid-month because of the rental, and that's where the depreciation comes in, all right? So if we go back to our Schedule E, basically, I mean, depreciation sounds like a fancy word, but as it says right after it, depreciation expense. It allows us to take little bites of the ownership of that rental or the things that we do to that rental to improve it or capitally improve it and put it against the rental income every year. User fees, this is other expenses. If we go in there, she had some user fees for garbage. And if we put that in there and we take a look, we go in, we have a little thing for other expense. Again, a great sheet because it has information that will carry forward every year. Each year we would do this individual's rental properties. So when you have somebody that owns multiple rental properties, it's great, okay? So you can see the user fee, and we put it under the column A for the property. Again, this will all carry forward, and then we can do this. If we have a user fee, and they just say, well, my user fees for all my properties were $5,000. Well, I own 5 properties, then we can put 1,000 under each one of the properties, okay? So, as you can see now, on the Schedule E, I have my rental income. I had all the things that I can do as expenses, including my depreciation, my total expenses. So actually, I'm showing a loss, okay, on my rental. Not uncommon. Because I'm doing this, there will be a little check at the bottom. It says, did you actively participate in the rental activity? I have to be renting the property. I can't own a rental that I have not rented and am not advertising to rent, and I'm just in the process of fixing up. I'm not actively participating, so there's not a lot I can do. Whatever I do to that property prior to renting it just would be added to my basis when I start depreciating it when it is actually being rented, okay? So we have the rental that is there, and that allows it to carry, when we check that box, to carry over our Schedule A. One thing that I will say about depreciation, you have to realize as the owner of rental properties that when you go to sell that rental property, that your basis is going to be what you paid for it plus all the improvements. However, you will have to pay back or recapture all of the depreciation that you took. The reason that happens is basically with depreciation and things you get to write off against your rental income, the IRS is feeling that you have had tax-free income from that rental property all the years that you owned it. You can see mortgage interest, taxes, and even just the depreciation, those items actually are greater than our rental income. So basically we're getting our rent-free, or tax-free, excuse me. So when you go to sell it, time to pay the piper, and you have to pay the IRS back, okay? So that is basically rental property. Like I said, there's some more details that are in the recorded lectures from the classroom times, okay? So when everything's back over there, you can see that it carries forward and it lowers our total income for our taxable income, okay? Now, as I talked about, the fact that Nancy lives in the other half of the property, we can see here's half of her real estate taxes on her Schedule A, half of her mortgage interest, okay? So those two things, all right, help her, okay, because that increases or exceeds her standard deduction, all right? So that is rental property. All right, I'm gonna turn off the mics and you can mute yours if you want to. Okay, anybody got any questions on rental properties?
No.
That's good. Okay. All right. Put everybody back on mute. Okay. I am going to get, and if you want to turn in your workbook, we're going to do kind of the same thing. All right. Let's see here. Hold on one second. All right, if you want to turn in your workbook to page 53, we're going to talk about self-employment, okay, or Schedule C, real briefly. It's on page 53. It's a lady by the name of Barbara Young. I'm just going to grab her return here, and we'll kind of do it very similar where we'll talk about the Schedule C, and that is self-employment or sole proprietor. Okay. All right, so let me bring this one up. We're talking about Barbara Young on page 54, 53, 54. Okay. All right. Okay, so we have Barbara Young here. Okay, so we have her tax return. She's actually filing as head of household. She has a dependent. Okay. No other income other than the fact that she is selling cosmetic products. Okay. So like a Mary Kay business. That being said, if we look at line 12, she has business income. All right. She is a sole proprietor. Okay. Now, if she was married and her spouse were both in the business, she could still be considered a sole proprietor because that's considered a joint venture. What that means is you get a special exemption that you're not a partnership if it is a married filing joint return and they both are in the business. Otherwise, partnerships or any other type of businesses, we saw that on the Schedule E, that we would have to put that on there and file a partnership, S Corp, and or C Corp tax return. Beyond the scope of this class, so we're not going to talk about that, but that's where those would go. We're strictly on a sole proprietor. So you can see here, we see that she had some income, okay? Well, just like any other business, when we go to file this, we're basically doing a small little business return that we have on here. We can see Barbara Young is selling cosmetics. In your textbook or in the quick finder or hitting F1, you can determine the business code that she is in. We can put the address that she is doing. If you notice the address there, it's basically her home. So we may have to think about a home office later on in the return or in the Schedule C, okay? Counting methods, most all the time we're going to do cash, okay? Accrual does come into play sometimes with inventory, but in this case, we're just going to stay with the cash, okay? Materially participating. The IRS has deemed that if in 3 of 5 years, you must have a profit, okay? You can't have losses all the time on your business because obviously you're not trying hard enough and they're not going to let you just keep writing off losses. Now, exceptions to that rule might be extenuating circumstances where some year you might have had, in this case for Barbara, maybe she had all of her inventory in her garage. She had a garage fire. Well, it might create where she has years of losses until she can recover from that loss of inventory, okay? So we have to kind of depend on what we do there, all right? It asks if you started or acquired this business this year. Again, that's that 5-year rule that we read about, okay? 1099s, same thing. With 1099s, am I having somebody that's working for me? Maybe Barbara has somebody that she has as a neighbor that she has come in and help put together mailers for her. Well, she pays her. If she pays her more than $600, she might have some labor or contract labor, issues them a 1099 so that she can write it off on her business, all right? Now, Part 1 talks about income, okay? If you remember, on page 1 of her 1040, it showed that she had $6,700 of taxable income. Just like any other business, you have gross sales and you have expenses. She is only taxed on her net profit. So we're going to kind of look and see how we get to that number, all right? You can see here, it talks about the fact that she had $42,703 of sales. It talks about the fact that there was $710 that were returns to dissatisfied customers. Well, those are things that she did not make money on, so she gets to take that away from her gross sales. Now, as you can see on line 4, we have cost of goods sold. Just like anything, you have to buy the goods to sell, and that's where it says from page 2. Well, if we look here, we can see that she had inventory at the beginning of the year that she carried over from the previous year. She bought $23,371 worth of product to sell, okay? She had part of that, $540, she kept for herself. She doesn't get to write off anything she uses as far as her purchases for personal use. So that's where we get that number, okay? And then you can see her ending inventory. In this case, she just has inventory. Cost of labor and materials, say I'm building birdhouses and I have somebody that helps me. Well, that's where we might have items for cost of labor and materials and supplies. In this case, she's buying the finished product at wholesale, so it's just inventory. If it was the case that she was making her own cosmetics and had to buy all the components of the makeup or the whatever the item might be, then that would be different there, okay? Now, also down here on this page 2, we have vehicle information. She has business expenses, okay? Or excuse me, business miles. You can see it talked about how many miles. The one thing it says in there is that she does the party method. As is the case with a lot of direct sales cosmetic type businesses, she drives home to home to do her parties. Well, that's considered her business, okay? And those are business miles driving between those. Make sure you check the box here because at 57.5 cents, you can see she gets to write off $7,833, okay? Now, this is based on the rate that the IRS says is a standard mileage rate. You get that, and that includes gas, oil changes, registration, etc., all the things of operating your car. If you would like, you can do an actual expense on this report where you take every gallon of gas, every oil change, everything like that. But I will say, at 57.5 cents, it's a better deal, okay? So you always have the option to list everything out. All right, back to the Schedule C, page 1, we can see that our cost of goods sold is carried over. So we have gross income. All right, so we have reduced it by our cost of goods sold. Now, we're going to put some expenses against this. All right, expenses that she has are advertising that she did. She has her mileage. Remember, that's a yellow number, so it's calculated from page 2 and comes over. Commissions and fees. Well, if she had somebody that worked under her and that lady that was coming over to help do the mailers, and that mailers generated some business, for everything that comes in off of the mailer that she sent, she might give her part of the sales, a commission, okay? Contract labor. Again, if she's paying that lady with a 1099, that might be where we have contract labor. Depreciation, okay? Depreciation on here is coming in from Chapter 6. What we're depreciating on there is very similar to what we do on the rentals, okay? We're going to get a 4562. All right, and on the 4562, again, talks about the description of property. All right, so we can go in there, and we have a description of property or our little asset worksheet. Okay, in this case, she bought one of those multi-function, a printer, scanner, copier for her office. IRS calls that data handling equipment, okay? We can see here that she has the cost basis, and that is a 5-year and a half year, so you can see the depreciation that she gets. So again, over the life, the 5 years that we think that that's going to last, she can put a little bit of expense towards each one of them. All right. Okay, so that is our depreciation. We had insurance. She must be carrying some liability insurance because she does not get to take the health insurance. Health insurance would show up for her on the adjustments to income on page 1 of the 1040. Okay. We have interest. Interest would be if she decided to buy a store and she had her own store that was separate from her home. Well, she might take a loan out. She could have a mortgage. Other interests might be credit cards. If she has a credit card that is in the business's name as a DBA, that interest that she pays on that credit card would be an expense. Okay. You can see as a business owner, there are certain things that we can write off that typically we could not put on our personal return when we're a W-2 employee. Legal and professional fees. Well, she has a lawyer and whatever else in preparation of her tax return and sales tax, she's paying somebody to do that. Office expense, just as it says there, okay? Office expense would be things like paper, pencils, all the supplies, okay? If she has employees and she chooses to either do an employee benefit program or a profit sharing program, if somebody's a large enough sole proprietor, they might have employees that they do provide health insurance or set them up with a 401k or a simple or a SEP retirement plan. That's where we can write these off. Rent. Say that she decides to get a storefront, but she can't buy it, so she rents. Or she has to rent a vehicle to do her business, or she had to rent a piece of equipment, or she's renting a booth at a trade show, okay? Repairs and maintenance is kind of a unique one here because repairs and maintenance are just that, repairs and maintenance. Say that she had to repair that printer, scanner, copier, okay? However, repairs and maintenance, if it's something that is a depreciable item, okay, we don't put it on repairs and maintenance, we might add it to a depreciable item or a capitalized item. Best example, the gentleman is a sole proprietor. has a tractor trailer moving company, and he has a truck that he drives all over the country moving people. He lives in Buffalo, making a delivery to Kansas City, but just outside of Chicago, his truck breaks down and needs a new motor. Well, obviously, we can't take that repairs and maintenance there. We're going to take that replacement of that motor and add it to the basis or the depreciable amount and the value of that truck when that repair is done, okay? So these are items that are not repairs to anything that's being depreciated. Supplies. Well, in this case, we have somebody selling cosmetics. Her supplies are not part of Part 3. They're not part of her cost of goods sold. Supplies could be gift boxes, gift bags, tissue paper, catalogs, things that she uses to sell her product, okay? Taxes. The only time taxes really show up here is if it's taxes that you did not recapture. What I mean by that is most of the time sales tax is a pass-through. You collect the sales tax on a product that you sell. You, in turn, file a state tax, sales tax report and pay it back to the state. So it's a pass-through. It doesn't really show up as income and expenses, okay, as long as your sales don't include sales tax. But if you have something where there is a return and you did not recapture the sales tax, that was kind of a loss that you paid to the state agency, then you can have that taxes. Travel and meals, same thing, okay, that we see on a lot of other things. We saw in our 2106 for a W-2 employee, meals and entertainment. We can write those off. Utilities, okay, in this case, it has long distance phone calls. I sometimes just have the utilities here as things that we would put in that are part of the, like if I have a storefront that I'm renting, that I pay the electric and gas, typical utilities. I like to put the other ones on page 2 in the miscellaneous if you're breaking down the cell phone. I'll talk about that in a second, okay? So we have those. Other expenses, if you go to Schedule C, page 2 at the bottom, we have a way to list, okay? So these are some things we broke out. Catalogs, we could have put under supplies, but we listed them here. Business license, again, there's a spot for that, but we can put it here. Postage envelope mailing, I might put under business expense. Cell phones and internet, this is where I like to list it because I will put cell, and then I would put 50% business, okay? Somebody has a cell phone, my question to them would be, excuse me. My question would be to them, how much is the line that is for you individually that are on the business? Well, they can't tell me, well, we paid $200 for my family plan. I just need to know their line. My next question would be, how many of the calls that you receive on that cell phone are for business purposes? Well, they say 50%. I would write cell 50% business use. And then I would do the total that they did that based on calculating that on their bill. Internet, same thing. Ask them about their internet. Now, the one thing that is kind of an exception to that, if somebody has a business that is kind of an internet-based business, they might be buying an upgrade to have a faster speed on their internet so that they can handle their volume of business. We might let a greater percentage or all of that go for the business because it's required of their business at home, okay? Now, the last thing that we have that sole proprietors can take care of is the home office. Now, the one thing I will say about the home office is it is an expense you can put against your tentative profit. You can see we have total expenses on line 28. We have tentative expense, or excuse me, tentative profit. Then we can subtract the home office. There's two methods to do this. One is to use the 8829, where you list all the different things. I'll let you kind of see that on your own, as you can go in there and take a look at the form. But on this one, it is a better deal to take the simplified method. The IRS has come up with this because home offices used to be a very abused category. What I mean by that is that people were writing off a bedroom, or as I've had with clients, show me pictures of their dining room where their dining room table's covered in papers. Okay? It's still a dining room. If there's a bed in it, it's still a bedroom. I don't care if it's a day bed that looks like a couch or a futon, it is still a bedroom, okay? It has to be a home office. So people were abusing a little bit the home office to try to lower their profits or their taxable income on it. The IRS then came up just a couple years back with this simplified method. You can look at the square footage of the home, whether you own or rent, and then enter the total square footage of the home that's used for business, and you basically get $5 a square foot, okay? That's where that's put against. Now, that being said, if on line 29, I had a negative number, or say that this line 29 said 1,000 for this return, my home office cannot make a negative profit or increase the negative profit. So if I have a loss on my business, I can't add to it with my home office, okay? I stop where I'm at. We can all do, if there's a loss, you can do a investment at risk, okay? So we can have all that. So we have our Schedule C. We can see, very similar to Schedule E, all the different things that we can do. The one thing I will say about the Schedule C versus a CEZ, it talks about it in the book. Obviously, CEZ would be a lot easier. It doesn't have all these boxes. It is great for somebody that is limited to what we see at the top. I know in your textbook it talks about what those limitations are to use a CEZ. However, for my students and when I teach and in my office, I encourage everybody to do a person sole proprietor on a Schedule C. If it's a small that it would qualify for a CEZ, I would charge them for the CEZ. However, I want you to learn to do it on a C, even though it might go on an EZ form, because then it lets you ask all the questions. You might miss something. Somebody that, say, is a driver, okay, makes $5,000, driving people around. Really all he has is maybe what he gets paid for $5,000, and then he might have a special license to drive people around, and he might have mileage. Well, CEZ. But I can ask him if I have my Schedule C. Did you buy a business card? Well, yeah, I did. Okay, that's great. We're going to take that. All right. Did you meet with any of your clients to set up your driving schedule? Well, yes, I did. Well, we might have some meals. Okay. Are you doing the billing at home? Well, yeah, I am. Okay. We might have office expenses. We might have computer. We might have internet. So it allows you to ask all the questions to make sure that if there's any expenses to put against that. Okay. All right. So that is a Schedule C. All right. All right. So I know I threw a lot at you. Do we have any questions on the E or the C?
Tim, hi, it's Liz. When you go through that Schedule C that you were just doing,
Yep.
if someone actually qualifies for the CEZ, is there a way just to toggle it? You know what I mean?
I mean, as far as charging?
Well, no. Rather than have to carry all that information that you just took on the C, is there a way to, it doesn't just transfer over to the CEZ? You'd have to manually do it?
You would have to manually do it. But what I'm saying is that you can just leave it on the C, but on the price sheet, you would charge them for an EZ because that's
okay. I see.
Like I said, I just prefer myself, and I teach my students and in my office to really use that C because it allows you to interview and find out the information that you need to about that person's business. Because there may be expenses that they never knew they could write off. If I'm just doing an EZ, I might say, okay, there's your income, there's your miles, here's your profit, here's your taxes. Okay?
Okay.
Hey, Tim.
Yes.
It's Monica. You did depreciation on some copier.
Mm-hmm.
Where did you see that? I didn't.
Oh, it's the thing that I did on that. That's actually when you go to Chapter 6 on the workbook. It's just an extension of it. There's no special problem. It's
okay.
on page 59.
Oh, okay.
Chapter 59, the workbook in chapter 6, it adds things on there, okay?
Okay.
Two other things I'll add on there, but you can pick up on them in the lectures from the classroom recordings. When we get done with somebody's profit, we calculate self-employment tax. What that is on a tax return is you are basically, as being self-employed, you are paying your Social Security and Medicare like you do on your paycheck on your tax return, okay? That being said, we talked about adjustments to income that you get credit for half of it. Well, actually what you do is you take your net profit and basically take about 92% of it. Employers get an 8% credit like that for doing the withholding for their employees. Well, you are both the employer and the employee as a sole proprietor. So the IRS is allowing you to get that 8% too. So you'll see in there when it talks about the Schedule SE, it talks about the calculation. The biggest thing you need to know is 92% and some odd decimals you get to take. And then once you get that amount, you take it times 15%, which is part of the Social Security and part of Medicare, and you get a credit for half, but that 15% is taxed. So if somebody says to you, hey, I'm starting a business, and next year on my taxes, I'll have a Schedule C. I'm thinking I'm going to have $10,000 in profits. What should I set aside? Well, you should know that, well, $10,000, you're going to pay about 15% self-employment tax. So basically, for every dollar they sell, they should plan to set 15 cents aside. That way they know they have the money to cover the taxes if they have no other deductions on their return. Okay? The other thing that's in there, and I'm still looking for my sheet, and I'm going to be terribly distraught if I don't find it. From moving from one office to another, I've misplaced my clergy sheet. It's a very brief discussion in there. We do a lot of clergy returns. They're kind of unique because they are W-2 employees that don't have Social Security and do pay self-employment tax. Sometimes they only pay self-employment tax on a portion. So they have kind of a unique situation where we calculate theirs. And I have a sheet that somebody passed on to me that is probably several things of Scotch tape, severely yellowed and tattered, but I got to find it because when I do a return, there's a very specific sequence that you must do for clergy, and I always use this sheet because if you don't do it right, you can swing somebody's return from owing $2,500 to a refund of $2,500. And a lot of times if you do it wrong, you won't find out till a couple years down the road when the IRS sends them a letter, and then they have to figure out not only to pay back the refund they got, but they might owe additional or vice versa, okay? So I'll make sure to find that and get copies of that to everybody because it's very good. The other thing that talks about is statutory employees. Statutory employees, the best example is somebody that sells insurance, all right? They are a W-2 employee for Social Security and Medicare, but they're self-employed for their income tax. You'll see the calculation, and it'll lead you through it. When you have a W-2 and right next to that box that we usually use for retirement, there's a statutory employee box, okay? All right, any other questions?
Yes, Tim, this is Cheryl.
Yes.
Can you just point me the right direction in our books to find proceeds from broker and barter exchange transactions from the Chapter 10 workbook problems?
As far as where to put that?
Yeah, I can't find it in the book to read about it or where to put it or anything.
Schedule D, capital gains.
Okay.
All right. Remember on the Schedule D, it was like our Schedule B. When we go into the Schedule D, everything goes on the Schedule D for capital gains or sale of stock, but nothing does. So we do that little worksheet, okay?
Okay, thank you.
So yeah, go look there. And in the workbook too, it'll show you how to get into the, down to all the way to the worksheet to put those in, okay?
Okay, thank you.
All right. Any other questions? All right. I did record this session, okay? So it will be up there if you want to come back and take a look at anything on there. Next week, we will be covering kind of some miscellaneous things that we have. I know that I will have a recording up hopefully this week when I get it from somebody else that will just be recording on depreciation, okay? All I want you to know for depreciation, I know there's a lot in the book about it, and understanding it is just making sure that you understand that it is an expense and making sure that you use your asset type to get to the correct amount of years to break it up over, okay? And what percentage is used, all right? The only other thing about depreciation that I want you to know is on something for a business, not for rental, but for business, we do have the option, and you see it a lot in the textbook, talks about a Section 179. That is an exception that we can take and take all the depreciation in the up front, okay? Example I use, I purchased this incredible helium tank that can blow up helium balloons faster than anybody else. So I can fill orders for balloons faster than anybody in Erie County. Well, I have incredible sales the first year because of this. Well, I had planned to take this fancy helium tank and depreciate it over several years. But because I did so well my first year and I want to minimize my self-employment tax, I check the little box for 179 and I take all my depreciation in the first year to put it against my income. It does mean I don't get to use it the rest of the years, but at least I could use it when I created the most profit, okay? Most of the time our profits may be broken up over several years or income, so we want to take our depreciation over, but in a case like that, I did an incredible business my first year with my new helium tank, so I'm going to use it there, okay? All right. Any other questions?
Tim, am I wrong, but Section 179 also can't cause a loss on the Schedule C, is that right?
That's correct.
Yep, and then what you do is you carry over the rest of it. Hopefully we won't run into that, but you would carry over the rest of it, right?
Yeah, like I said, you know, the only time that I really talk to somebody about a 179 is if they do have, where they have an out of character or, you know, a huge spike in sales and something that they purchased can be put against that. Otherwise, most of the time, it's still a better deal to break it up over several years. Okay. All right. Has everybody got their Christmas shopping done?
Yeah, right.
All right. Like I said, so next week we'll kind of talk a little bit about healthcare and things like that. So if you want to read about Chapter 15, don't get caught up in it. I'm going to pick a few problems. We'll probably spend next week kind of recapping, and I'm probably going to pick about 3 problems and do them. We're kind of to that point. We just need to keep redoing information and problems and stuff like that. As you have things like Cheryl asked about her Schedule D, or, you know, you have different questions about things, you know, just continue on those. So go ahead and do the problem that is 5-6, okay? And if you want to do the other problem in 9, or the problems in 9, you can do those, okay? Not worried about the quizzes at this point. Everybody's been doing great turning in information, so don't worry about turning in the quiz information. Just make sure you're going through the exercises in the book so that you learn how to do the calculations, okay? For those of you that have not realized it, and I think I had said it early on, but at the back of Volume 2, you do realize that there for the quiz and the exercise. So I had somebody in one of my in-classroom that had not realized that and maybe missed me saying it and didn't realize that she could check her answers back there. So, okay? So the answers are in there for you. All right? All right. Anybody have any questions during the week? Just let me know, and otherwise, enjoy the rest of your weekend.
You too. Thank you.
You too, thanks.
Bye.